Last year, 5 banks failed, and we predicted it was just the beginning. Man, I'm so tired of being right all the time. Welcome to America Uncovered, I'm Chris Chappell. In terms of raw dollars involved, 2023 was the biggest year ever for bank failures. In terms of cooked dollars, why are you cooking dollars? Don't you know how flammable they are? Well, they may as well set them on fire because 5 banks collapsed, worth a combined total of $548 billion, the largest in a single year. That is the largest so far. Because when we reported on it in January, we predicted that it was just the beginning. Well, folks, just like when you think Lord of the Rings: Return of the Kings is finally finished, turns out it's definitely not over yet. On April 27th, 32-branch Philadelphia-based Republic First Bank collapsed, the first bank failure of 2024. That's Republic First Bank, not to be confused with First Republic Bank, which collapsed last year. Why are bank names also familiar? Bank First Republic and Republic Bank First better watch out. As a result, roughly $6 billion in assets seem doomed to plunge into the financial abyss where all toxic assets go to die. Except that at the last moment, the FDIC swooped in and concluded a deal to protect Republic First Bank's assets from annihilation. The FDIC is basically the senzu bean of the finance world. They managed this by convincing another similar-sized Pennsylvania-based lender, Fulton Financial Corporation, to acquire nearly all of their failed competitors' assets in a corporate buyout. Since they approved mergers, the FDIC might be more like the fusion dance. This is great news for the American taxpayer, since around 90% of Republic First's $6 billion in assets became the responsibility of Fulton Bank, a private lender, meaning that the failure cost the publicly funded FDIC only $667 million. That's a pretty good trade for the public, especially considering the historically low amount of money the FDIC has access to right now. But don't worry, everything's fine. You're definitely not being gaslit about the economy. Economists looked at the failure of Republic First Bank and warned that more bank failures could be on the horizon. And then on May 29th, the FDIC released a report stating that the U.S. banking system reached $517 billion in unrealized losses and that 63 lenders are on the brink of insolvency. So yeah, it just keeps getting better and better. We've already talked about what these bank failures could mean for the U.S. and world financial system, but why is this happening? Well, there are 3 major factors. Number 1, commercial real estate loans. In February, the New York Times reported on the large number of zombie offices, office buildings around the country that have been sitting vacant since 2020. Zombie offices are a big problem for banks, which hold around $1.4 trillion in commercial real estate loans set to mature by 2029. And that's a pretty staggering amount of money. It's also more than half of the total CRE loans in existence. Why are the office buildings sitting vacant? Well, to put it bluntly, it's the natural result of all those pesky, unlawful lockdown mandates that were going around faster than that virus that escaped from a Chinese lab. These led to the widespread adaptation of telecommuting, also known as remote work, which also led to the widespread adoption of the business jacket and bare leg look. Who could have predicted that introducing a system in which office workers can do their jobs from the comfort of their own toilets would result in people not wanting to return to their soul-crushing cubicles and professionally offended HR departments? Yeah, definitely couldn't get away with taking your pants off around them. Now, commercial real estate isn't just office space. It also includes healthcare facilities, industrial properties, retail stores, storage locations, and apartment buildings. Yes, apartment buildings where people live count as commercial real estate rather than residential. I guess charging rent is just way too profitable, especially when it's too damn high. But the empty offices are a big problem for lenders because they're a huge financial liability. Businesses tend to stop paying rent for offices that aren't going to be occupied, which means that whoever owns the building isn't getting money, and that makes it hard for them to pay back the loans they took out to buy the building. As such, those loans, once a sure bet for the banks that owned them, have become so toxic, the professionally offended HR department wants to have a word with them. Which is why in March, the Federal Reserve Chair Jerome Powell said there will be bank failures caused by commercial real estate losses. Who would have known that working with no pants would cause a domino effect leading to bank failures? We're living in the stupidest timeline. But surely the banks learned their lesson in 2008 and actually had the money needed to back up their loans, right? Okay then. It's particularly bad among regional banks, especially in California, where most of the failed banks in 2023 were. Indeed, a year later, according to Bloomberg, California lenders have outsized property debt concentration. What? Poor decisions being made in California? Well, I guess I'll add that to the list. Regional banks simply don't have the capital to set aside, so they're just plowing ahead. One regional bank is even bragging about it. River City Bank, based in Sacramento, California, boasts that it's a mid-sized firm that thinks big. The reason they say this is because as of the end of 2023, the bank had a CRE loan value on their books that was a staggering 660% of the bank's total on-hand capital. That's not good. That's like if someone saw college students crushing loan debt and thought, now there's a winning business model. They aren't the only ones. Of California's 127 banks, 31% hold property debt that is above 300% of their capital, which is the highest number of significantly exposed banks of any state. While California is the worst, many states are in similar situations. But in early April, the Federal Reserve's Vice Chair for Supervision reassured Americans that the overall banking system is sound and resilient. Then, immediately afterward, he compared watching the banks groan under the stress of bad CRE loans to watching a slow-moving train wreck. No, wait, not train wreck, just train. He said slow-moving train. It's nothing at all like watching a slow-moving train wreck. That would be horrifying. And we shouldn't be horrified because the banking system is sound and resilient, like a train that survives a wreck. We know that because someone in a position of authority told us so, and we should always trust authority figures and never question them. Joking aside, overexposure to toxic commercial real estate debt is a serious problem, the full consequences of which have yet to be seen. And on May 29th, the FDIC reported that many banks also have unrealized losses on residential mortgage-backed securities, which is to say, overexposure to toxic residential real estate. Just like in 2008, why does this all sound so familiar? But don't worry, based on how reckless these banks are being, the consequences might be seen sooner than later. Did I say don't worry? I meant immediately worry. Yep, the banks have made some pretty bad decisions, but it's not all the bank's fault, which leads us to number 2, high interest rates. You may have heard that the Federal Reserve, also known as the Fed, has been hiking interest rates. The idea is that hiking rates will contain inflationary forces and maintain maximum levels of employment, all while steering the economy clear of recession. Runaway inflation is no joke. Imagine if a meal from McDonald's cost almost $20. Wait, they do in some locations? This inflation is higher than my cholesterol after eating there. Rate hikes could help, but they're not without their drawbacks. In fact, some people have blamed the Federal Reserve's rate hikes for the bank failures, including Time magazine, which said in May of 2023 that the Fed's latest interest rate hike could set off a domino effect in regional bank failures. Even the Fed itself admitted some blame for Silicon Valley Bank's failure, though they cited poor oversight, not rate hikes. So it wasn't a bad decision, it was just negligence. That makes me feel same actually, not great. So what are these rate hikes and why are they a threat to banks? Well, the federal funds rate is the interest rate that banks pay when borrowing money from each other. It's set by the Federal Reserve, which is itself a bank, so by definition, the federal funds rate is also the interest rate that commercial banks pay on loans they get from the Fed. During COVID, the Fed lowered the federal funds rate to nearly 0%. Meanwhile, the federal government handed out stimulus packages like Halloween candy, and you didn't even need to wear a costume for it. Well, I guess everyone was wearing masks. By sheer coincidence, inflation in the 2020s has become almost identical to inflation in the 1970s, fun times. Hence the Federal Reserve's aggressive rate hikes. These rate hikes also made refinancing loans pretty unattractive, because who in their right mind would borrow at a higher interest rate to pay off a lower rate loan? The answer to that question is someone who has no choice, like, say, someone who has a commercial real estate loan maturing in 2024 who can't pay it off. Unfortunately, if we go by the numbers, that appears to be a lot of someone's. In June of 2022, a full 8 months before the first bank went bust in 2023, a team of academics published a research paper that predicted a nationwide $664.1 billion value destruction of office property in the near future, in an event they referred to as an office real estate apocalypse, which, no, isn't the same office real estate destruction as the ending of Fight Club. As far as I know, no one talks about Fight Club. Other publications had other colorful phrases to describe the situation. Here's an article from MarketWatch in December of 2022 that says the party is over in commercial real estate. And here's one from the New York Post, published in October of 2023, that says U.S. office prices are headed for a severe crash. And one from Investor Place, also in October of 2023, that says $1.5 trillion crisis is brewing for investors. According to the Mortgage Bankers Association, $929 billion in commercial real estate debt will come due in 2024. Why so much? Well, a lot of office mortgage holders have been kicking the can down the road by getting lenders to agree to push back their loan due dates, mainly by selling the idea that economic recovery or a reduction of the Fed funds rate must be just around the corner. Yep, any minute now. Any minute now. The official name for this process is amend and extend, though more cynical investors generally prefer the phrase extend and pretend. The key takeaway here is that the number of office loans that were amended and extended from due dates in 2023 to 2024 increased by a whopping 41% since 2022. That's a lot of can kicking, but the road is only so long. Eventually, the piper must be paid. Man, who knew where the sidewalk ends was an economic metaphor. The only question is, when? Number 3, Bank Term Funding Program. The final component to the ongoing crisis is that the Bank Term Funding Program, against all expectations, actually ended as scheduled on March 11, 2024. The Bank Term Funding Program, or BTFP, was a special program by the Federal Reserve to give emergency loans to floundering banks. The program was started in March of 2023, just as the banking crisis started. The details are essentially financial witchcraft, so we won't bore you with them. The important thing to know is that the Fed announced a tentative ending date for the program and, amazingly, stuck to it. Nobel laureate economist Milton Friedman famously said, "There's nothing so permanent as a temporary government program." As with most things, however, there are exceptions. Well, I guess everything's okay then. The Fed stopped their emergency lending program to struggling banks. I guess it's no longer needed and there's nothing to worry about. Good job, everyone. Yeah, no, at least not according to Goldman Sachs, which said in a research note published in March of 2024 that office mortgages are living on borrowed time. Specifically, the note said the ongoing downward pressure of office property prices and net operating income growth could push borrowers to strategically default, which means a borrower will actually lose less money if he just chooses to stop paying his mortgage and let the building get repossessed by the bank. The note went on to say the ability of balance sheet constrained lenders to continue to amend and extend loans could diminish over time. In simpler terms, the banks are running out of money, and the road they've been kicking the can down, the sidewalk is about to end. Things aren't looking too good for the American banking system in the near future. There's been one bank collapse this year so far, but I'm guessing it won't be the last. For now, it looks like all we can do is wait and see what happens. Maybe there won't be more bank collapses after all. Maybe the Fed will revive the Bank Term Funding Program emergency measure. Maybe the empty office buildings could be converted into a more profitable type of commercial real estate, like apartments, medical facilities, or gigantic trampoline parks. Hey, I'd pay to go there. Maybe people will decide they'd rather get off their toilets and go back to a grinding commute to a soul-sucking physical location to do work they can do from literally anywhere the internet is. I'm just going to guess that it won't be the last one. And a lot more raw dollars may soon be cooked. Once again, I'm Chris Chappell. Thanks for watching America Uncovered.